So welcome back, friends. We had the Dow, S&P, Nasdaq off to a decent start for the Nasdaq. It was up over 160 points, but it is beginning to falter now as we go further into the session. In my morning video, or rather I would say early morning video, I had mentioned that as we go past, say, about 1 or 1:30, you may see the selling increase in the markets today. This is quite a momentous week for the US markets, with the big tech earnings about to start rolling out. So we have the Metas, the Microsofts, all coming out with their earnings. And equally important is the Federal Reserve decision on Wednesday. More importantly, its policy statement about where it expects the interest rates to be headed this year and beyond. So we have that Federal Open Market Committee, or FOMC as it is popularly called. It is poised to again hold its benchmark interest rates steady at a 23-year high of 5.25 to 5.5% when its two-day gathering ends on Wednesday, friends. While the rate decision itself looks to be baked in the cake, the meeting will serve as an important platform to further tee up a monetary policy pivot as early as September. There's a very high chance that there may be a first interest rate cut in September, but wait friends. Let's wait till Wednesday policy statement of the FOMC. What has given officials latitude to more directly embrace the idea of rate cuts is clearer evidence that after many fits and starts, inflation is finally beginning to get under control. Consumer price growth has eased meaningfully in the recent months, friends, taming fears that flared up earlier this year after an unforeseen hiccup. And once a concerning contributor to inflationary pressures, the labor market has also entered a new phase. Hiring has slowed down from its red-hot pace earlier this year, resulting in slower wage growth. Layoffs are rising, pushing the 3-month average unemployment rate up 0.43 percentage points compared with its lowest point in the past 12 months, just shy of the 0.5 percentage trigger for the SAM rule, which marks the start of a recession. Friends, the markets look to be a little tepid today, but I believe that afternoon session may see some more dips. Be careful. Layoffs are rising, pushing the 3-month average unemployment rate up 0.43 percentage points compared with its lowest point in the past 12 months. Officials want to maintain a healthy labor market and recognize that keeping their policy rate too high for too long jeopardizes that. Fed is likely to acknowledge these developments on Wednesday in a revised policy statement and during the press conference held by Chair Jay Powell. Back in June, the FOMC wrote that there had been only modest further progress towards its goal of getting inflation down to 2%, and that it was highly attentive to inflation risks. Moreover, it has long said that it would not deem it appropriate to reduce interest rates until it had gained greater confidence that inflation was moving sustainably towards its long-term target. Economists expect the Fed to acknowledge that further progress has been made. The central bank's preferred inflation gauge now hovers at 2.6%, well below its 2022 peak. They also believe that a statement will emphasize that elevated inflation is not the only risk confronting the Federal Reserve now, that the labor market has also softened. As Powell has stressed, the central bank is also at risk of causing undue job losses if it fails to act quickly enough to offer relief to the American businessmen and to the borrowers. Lastly, the FOMC is likely to affirm that it is more confident about its handle on inflation and in turn its readiness to lower interest rates. Powell and other officials have so far demurred from commenting specifically about the timing of the first move, instead saying that the decisions will be made meeting by meeting and hinge on how the data evolves. Between July and September gatherings, the Fed will receive 2 sets of inflation and jobs reports, among other updates. Forecasts suggest that the upcoming information will confirm the need to reduce interest rates. That will be confirmed by the inflation and the job reports over the next 2 months. It is possible that the Fed is on the verge of making a mistake in delaying a rate cut until September. That's what many believe, given the slowdown that is already underway in the economy. On the other hand, if you look at the US GDP growth numbers that were just released, it shows a rather resilient economy. So I believe that in many ways the Fed could be stuck between the devil and the deep sea. Although it might already be too late to fend off a recession by cutting rates, dwindling now unnecessarily increases the risk, according to former New York Fed President Bill Dudley speaking last week. Fed, however, sees several benefits to waiting, and it makes no mistake in ruling them out. For one, the central bank has been wrong-footed in the past, and officials want to be absolutely certain that they have a handle on inflation before making any big policy moves. There also remains a range of views internally about the appropriate path forward for rates. As recently as in June, there was a nearly even split between policymakers projecting just 1 quarter point rate cut compared with 2 for the year. Powell probably feels that he can't really get the consensus together to go until September. But then there is another problem that is waiting, is the elections. Donald Trump does not look to be very happy about interest rate cuts until he assumes power. There's a risk that you don't go soon enough, but there is also a risk that you go a little too soon and you have to reverse course. So damned if you do, damned if you don't. Given what they experienced with inflation picking up at the beginning of the year, they are probably leaning more into that second risk. And we have that it seems to be prudent for the central bank to wait until September to kick off its easing cycle. In the event that the labor market weakens much faster and by a larger magnitude than expected, the Federal Reserve could get back to a neutral policy setting, one that is longer beating back demand fairly quickly. So there is scope for additional rate reductions, of course, in November and December before the central bank presses pause until September 2025. I would say that the elections will also play a major role, whether we like it or not. And we assume that the Federal Reserve is an autonomous body, but you have the candidates in the waiting for the president. And particularly now Donald Trump signifying that he would wait for the interest rate cut until he actually assumes office. It's going to be an interesting policy statement coming out on Wednesday. Do stay tuned, but I believe that you're likely to see many dips and negative periods this week. All is not going to be so hunky-dory, and definitely be on the watch out to get to know where the markets are headed from here for the US markets. Do join my Prime or Prime Plus Telegram groups. You can do that by WhatsApping us on 982-086-1044. Alternatively, you can also email us at globalmoneyinvestor@gmail.com. Happy investing and have a great investing day ahead. God bless you and God bless America. Thank you. Bye-bye.